Hello dear traders, the situation on Wall Street is not calm. Last week the US stock market dropped to its lowest level since May. The S&P lost more than 10% from its July peak. This means that a correction has begun. However, the beginning of the new week seemed to be encouraging. On Monday, stock indices opened on a positive note. Thus, the S&P added 0.7%, the Dow Jones rose by 300 points, while the Nasdaq 100 increased by 0.5% amid favorable seasonal conditions. The sectors of communication, services and technology, as well as consumer discretionary, showed good results. Stocks of Microsoft, Amazon and Meta advanced by 1.8 to 0.5%, whereas stocks of McDonald's added 1.9% as the company's earnings exceeded the forecast. At the same time, Tesla stocks lost about 4%. Apple, Pfizer, Advanced Micro Devices, Qualcomm and Eli Lilly will disclose their reports this week. Traders are also preparing for the Fed's key rate decision and the publication of labor market figures, including job openings and employment data. Notably, on Wednesday, the Fed's meeting is not the only event that will attract traders. Let us take a closer look at the situation. Stay tuned. The financial market is always reaching unexpected and interesting events. Watch the video to the end and share your opinion in the comments. Thus, all eyes will be turned to the new borrowings plan of the US Treasury Department. The plan will be issued just several hours before the announcement of the Fed's decision. The official statement on the quarterly refunding will clarify how intensively the department is going to increase the issuance of long-term government bonds to cover the growing budget deficit. Mounting demand for treasuries boosted their yields, which reached the highest level since the global financial crisis of 2007-8 years. This, in turn, increased debt servicing costs. Investors still cannot understand whether the Treasury Department will boost the issue of long-term bonds as it was in August. At present, traders are focused on the initial emissions because of the pause in the key rate hike. In other words, government debt management is a more crucial point than the FOMC meeting. Earlier, Jerome Powell said that the rise in bond yields could have the same effect as interest rate hikes. Data published in October revealed that the public debt in the 2023 fiscal year doubled compared to the previous year and totaled $2.02 trillion. Notably, such an economic situation in the US forced Fitch Ratings to downgrade its sovereign rating. As for the Fed's meeting, the GDP data may influence the committee's decision. According to the initial estimate, in the third quarter, the economy showed the best results since the end of 2021, thus causing mixed reaction. Since most analysts suppose that such strong GDP data is just a short-lived phenomenon, it's likely to shape the meeting results. According to the data, traders are almost 100% sure that the Fed will keep the key rate at the level of 5.25–5.5%. If in the fourth quarter GDP fails to slacken, the likelihood of the key rate hike in December may jump. At present, markets estimate the possibility of such a scenario at just 24%. Even if the benchmark rate is already at its peak, the improvement in the economic situation could be a reason for the Fed to keep the key rate at high levels for a longer period. However, the current GDP data for the third quarter could be revised. On Wednesday, investors should pay close attention to the statements about the US economic condition and outlook. Considering the macroeconomic indicators, the US labor market figures will be of greatest importance. The number of new jobs in October may slacken to 188,000 from 336,000 in September, while the unemployment rate could remain the same at 3.8%. Last week, the Dow Jones dropped by 1.9%. The middle of the week was the most challenging period for the three main indices. Even the Dow Jones, which was the most resilient to bearish sentiment, finally slumped. Traders remembered this day for a kind of dispute between the fans and those who do not support artificial intelligence. The market reaction was strong. This was clearly reflected in the shares of artificial intelligence companies. The data issued by Alphabet, the parent company of Google, only fueled the situation as it was below expectations. A slump in Alphabet shares amid the data publication caused the sell-off of shares of other largest tech companies. Stock of Amazon and Meta platforms also suffered losses, despite the absence of negative corporate news at the moment. Sometimes the market situation may provoke a massive sell-off. This happens when investors see a decline in the shares of one company and become concerned about the shares they have put in money. Positive figures from Microsoft and a rise in new home sales in September failed to encourage traders. In general, the positive results of most companies included in the S&P index demonstrate the stability of the U.S. corporate sector despite various macroeconomic challenges such as inflation, supply problems, and global political risks. The fact that 78% of issuers exceeded profit forecasts and 62% beat revenue expectations points to the strength and adaptability of most U.S. corporations. If in the third quarter the overall EPS growth for the S&P companies totals 2.7% compared to the previous year, this will be a clear sign of recovery after the previous 4 quarters when indicators were weaker. This will confirm the fact that companies are increasing their efficiency and optimizing operating costs. Meanwhile, during the week, the S&P decreased by 2.4%. From a technical point of view, the sell-off accelerated after the S&P failed to break a resistance level in the middle of October. Just after that, the index slumped, followed by a short-lived consolidation. On Monday, the situation changed a bit. The overall situation of the S&P looks positive. The indicator rebounded from 4,100. Now it may return to 4,330. The Nasdaq 100 also sank by 2.4% last week. Since the current week is rich in important events, it may determine market movement until the end of the year. In the short term, signs of oversold conditions may indicate a rebound. The rapid recovery of the market before the start of regular trading resembles the situation observed in early October. In September 2022, a similar rebound generated significant interest in stocks. Curiously, after almost 3 months of decline, the market has become interesting for investors, taking into account strong consumer demand in the US. However, one should be careful with active investments because there is a risk of going against the current trend. Apple will also publish its financial results for the quarter this week on November 2nd. Analysts foresee an insignificant drop in earnings caused by a decline in the sale of main products. It will be interesting to learn about the company's forecast for the holiday period and data on sales of the new iPhone 15. Apart from that, investors will be waiting for reports from McDonald's, AMD, Caterpillar, Qualcomm, Eli Lilly, Pfizer and PayPal. We continue to monitor the stock market situation to keep you abreast of the latest events. Subscribe to our channel and leave your comments. We are working for you, making the most relevant video reviews every day and every week. That is all for now. See you later.